App Capital presents Deep Dive on American Express. What if one of the world's most recognizable financial brands, a staple of luxury and travel, isn't just a credit card company? It's a century-and-a-half-old financial hybrid that makes money in a way its biggest rivals can't. Today, this report dives deep into the stock of American Express, ticker AXP, to uncover its secrets, analyze its risks, and explore why some of the world's most famous investors have sworn by it for decades. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your AI host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about American Express, the company and its unique foundation. American Express Company, commonly known as Amex, has a history that is surprisingly rooted in the transportation industry. It was founded on March 18, 1850, by three prominent transportation businessmen: Henry Wells, William G. Fargo, and John Butterfield. These individuals would also go on to create the famous Wells Fargo & Co. The company's original business was freight forwarding, tasked with safely transporting goods and valuables across the United States. This focus on security and trust established a foundational brand identity that would persist for over a century. The company's evolution into a financial services giant was a series of strategic adaptations. In 1883, Amex developed the money order to help immigrants send money home safely. This was followed by the introduction of the iconic traveler's check in 1891, a product that allowed customers to manage their money securely while traveling abroad. The company's pivotal entry into the credit card market occurred much later, in 1958, when it introduced its first charge card. This long history of successfully pivoting its business model from a physical freight company to a digital financial giant suggests a fundamental institutional capacity for adaptation and resilience that is a key qualitative asset. The brand equity built on trust, dating back to its freight forwarding days, is an intangible but powerful competitive advantage that has enabled it to survive and thrive through numerous economic cycles. The most critical aspect of the American Express business model is its closed-loop network. Unlike its primary competitors, Visa and MasterCard, which operate as pure payment networks, American Express functions as both the card issuer and the payment processor. When a cardholder uses an Amex card, the company handles the entire transaction, from issuing the credit to receiving the payment from the merchant. This integrated model is the central determinant of Amex's entire investment profile. This unique structure enables Amex to generate revenue from multiple sources, primarily from two key groups: cardholders and merchants. Merchant discount fees. When a customer uses an Amex card, the merchant pays a percentage of the transaction amount to American Express. This fee, known as discount revenue, typically ranges from 2% to 3.5% of each payment. This is notably higher than the fees charged by competing networks and represents the largest portion of the company's gross income. Annual fees. The company offers a range of premium cards, many of which carry substantial annual fees. These fees can reach as high as $695 for publicly available cards and up to $5,000 for the invitation-only Centurion card. This provides a stable, subscription-like revenue stream. Interest charges. As a card issuer, American Express provides a line of credit to its cardholders. For those who carry a balance and do not pay in full each month, interest accrues, representing a significant source of revenue. Other fees. Additional revenue streams include foreign exchange fees for international purchases and various other charges for late payments, balance transfers, and cash advances. This business model explains both the company's high profit margins and its limited global market share. The ability to charge higher fees is a direct consequence of the integrated closed-loop model. The positive effect of this is that it funds the exclusive rewards and benefits that attract a loyal, high-spending customer base. However, the negative ripple effect is that these high fees can deter some merchants, limiting card acceptance, particularly at small businesses and in international markets. It is a deliberate trade-off of quality over quantity. American Express is led by Chairman and CEO Stephen Squeri and CFO Christophe Lecayec. Under their leadership, the company has focused on strategic initiatives aimed at expanding its position in the premium consumer and commercial payment segments and improving its global integrated network. A decade of financial performance, 2015-2024. American Express's financial history over the last decade demonstrates a clear pattern of consistent growth, punctuated by the significant economic downturn of 2020 and a powerful recovery thereafter. The company's financials exhibit a pro-cyclical pattern, acting as a bellwether for premium consumer spending and global travel. The 2020 data is not a red flag of fundamental weakness, but rather a clear demonstration of this sensitivity. The subsequent recovery underscores the underlying strength and brand loyalty. From a revenue perspective, the company has experienced a steady increase over the last decade. Annual revenue grew from $34,441 billion in 2015 to $74,201 billion in 2024, a significant increase of more than 115%. This growth was particularly strong in the post-pandemic years, with revenue increasing by 21.1% in 2023 and 10.15% in 2024, demonstrating a powerful rebound in consumer spending. Net income followed a similar trajectory, growing from $5,063 billion in 2015 to $9,995 billion in 2024. The sharp dip in revenue and profit in 2020 was a direct result of the pandemic's impact on travel and entertainment, a primary business segment for Amex. The rapid recovery to record revenues in 2024 indicates that the core business was not permanently damaged by the event. The company's financial leverage, measured by its debt-to-equity ratio, has remained relatively stable over the past decade. In 2024, the long-term debt was $49,715 billion, an increase from $61 billion in 2015. The average debt-equity ratio for 2024 was 1.72. For a financial services company that uses debt to lend money and fund its operations, this ratio should not be compared to a typical industrial company, but rather to its peers. For context, American Express's debt-to-equity ratio is higher than Visa's, around 0.52, but lower than MasterCard's, approximately 2.10. This shows that its leverage is within the industry's acceptable range and is not a singular red flag. In terms of profitability, Amex's net profit margin has fluctuated, but has remained strong, averaging 13.33% in 2024. The gross profit margin has also remained healthy, averaging 64.8% in 2024. The margins dropped sharply in 2020, but quickly recovered, once again demonstrating the company's resilience. The following table provides a clear overview of the company's financial performance. The Benjamin Graham valuation. The principles of Benjamin Graham, the father of value investing and mentor to Warren Buffett, provide a framework for determining a stock's intrinsic value. One of the most well-known of these is the Graham number, a formula designed to identify stocks that are priced below their fundamental worth, thus offering a margin of safety. With a current market price of approximately $323, this analysis suggests that American Express is overvalued by a significant margin at 165.38% above its calculated Graham number. This conclusion is further reinforced by two of Graham's core rules for defensive investors. A stock's price-to-earnings (PE) ratio should be no more than 15, and its price-to-book (PB) ratio should not exceed 1.5.25. American Express currently has a PE ratio of 23.0927 and a PB ratio of 6.8x4, violating both of these criteria. This seemingly straightforward conclusion of overvaluation is not the full story. The application of a historical valuation model to a modern, growth-oriented financial company highlights its limitations and reveals the increasing importance of intangible assets in valuation. Graham's model was designed for a different era, one with lower growth and less reliance on intangible qualities like brand and network effects. The formula fails to capture the true value of American Express's brand equity, its powerful customer loyalty, and its dominant position in the high-end payments market. A more telling comparison is a relative valuation against its direct competitors. When viewed against Visa and MasterCard, Amex's valuation metrics tell a different story. As the table demonstrates, American Express's P/E ratio of 23.09 is significantly lower than Visa's 33.54 and MasterCard's 39.62. Similarly, its P/B ratio is dramatically lower than its peers. Most compellingly, its PEG, price earnings to growth ratio of 0.56 is far superior to both Visa's 1.56 and MasterCard's 1.71. The PEG ratio is particularly relevant as it accounts for future earnings growth, a factor that Graham's original formula largely ignores. This contradictory evidence suggests that while American Express may be overvalued by a rigid historical standard, it appears to be priced at a discount relative to its most direct and relevant competitors. The bull versus bear case. The investment story of American Express is built on a series of deliberate trade-offs, and the bull and bear cases are two sides of the same coin, each point directly stemming from its unique business strategy. Resilient, high-margin business model. The company's closed-loop network and high-fee structure generate robust, subscription-like revenue from card fees, providing a stable income stream. The company continues to project strong revenue growth of 8% to 10% and earnings per share growth of 14.2% for 2025. Loyal, high-spending customer base. American Express's focus on premium products and benefits has cultivated a highly loyal customer base that exhibits significantly higher spending per card than competitors. This spend-centric model is a powerful engine for revenue growth. Strategic initiatives and strong financial health. The company's upcoming Platinum Card refresh is a key catalyst expected to drive continued growth and engagement. The company also maintains what management has called best-in-class credit performance with low loan write-offs and past due rates. Vulnerability to economic downturns. American Express is highly dependent on consumer spending, particularly in travel and luxury categories. During periods of economic contraction or recession, discretionary spending tends to decline, which can directly impact the company's earnings, as was seen in 2020 and the Great Recession. Limited merchant acceptance. The direct trade-off for the high-fee model is lower acceptance. While American Express has achieved virtual parity acceptance in the US at 99% of locations that accept credit cards, it is still much less accepted in Europe and Asia, particularly at small businesses. Competition and disruption. The financial payments market is becoming increasingly competitive, with the rise of digital wallets and mobile payment platforms like Apple Pay and Google Pay. These newer platforms may offer lower fees and more convenience, potentially eroding Amex's market share over the long term. High debt load. While the debt is largely used for lending, the company's increasing long-term debt and debt equity ratio may be a source of concern for more conservative investors who are sensitive to financial leverage. Conclusion. American Express is a complex company that defies simple categorization. It is not a pure payment network like Visa, nor is it a traditional bank. Instead, it is a brand-driven financial hybrid that has strategically positioned itself to capture the high-end, high-spending segment of the market. Its financial performance over the past decade demonstrates a track record of strong growth, interrupted but not broken by economic events, with healthy margins and strong credit quality. Technically, the stock is in a long-term bullish trend, but may be due for a short-term correction, as indicated by its overbought RSI. In terms of valuation, the company appears significantly overvalued by the rigid, historical standard of the Benjamin Graham formula. However, when compared on a relative basis to its most relevant peers, Visa and MasterCard, American Express appears to be trading at a compelling discount. The investment story of American Express ultimately rests on a fundamental belief. Do you believe that a focus on high-value, high-spending customers can continue to thrive in an increasingly competitive world? The bull case is built on the strength of its loyal customer base, its brand resilience, and its strategic growth initiatives. The bear case centers on its vulnerability to economic downturns and the competitive threats posed by a rapidly evolving payments landscape. Ultimately, American Express is a company with a rich history and a unique, profitable business model. It is a premium stock whose value is as much in its intangible assets of brand and customer trust as it is in its financial metrics. This report is for educational and informational purposes only. It is not a recommendation to buy or sell any security. All investment decisions should be made with caution, and it is highly recommended to consult a qualified financial advisor before making any investment. The information presented is based on publicly available data and does not guarantee future results. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.